Welcome everyone. Today we're diving into a critical skill for any aspiring mill leader, how to bridge the gap between financial results and mill reality. Whether you're looking at a public 10K or a private earnings report, our goal is to understand how a future general manager reads EBITDA, cash costs, and operating risk to drive performance on the mill floor. It's important to remember that a profitable corporate group can easily hide a dying mill. On paper, revenue and EBITDA might be up, but at your specific site, volume could be dropping while maintenance debt piles up. As a GM, your job is to reconcile these high-level enterprise results with the physical performance of your critical assets. By the end of this session, you'll be able to navigate financial statements with confidence. We'll cover how to translate metrics like FX and volume into earnings movements and, more importantly, how to use that data to decide on corrective actions, whether that's investing capital or considering a suspension. Our journey is divided into 5 chapters, moving from the rules of reporting to direct mill intervention. A key rule we will follow throughout: never accept a percentage or a per ton metric at face value until you know exactly what is in the numerator and the denominator. In Chapter 1, we look at the who and the what of reporting. While public companies follow strict standards, private company reporting is a different world driven by lenders, tax authorities, and specific jurisdictions. A financial result is an ecosystem, not just one document. You need to read the regulated filings alongside management's narrative in the investor deck and the physical evidence on the plant floor, like yield and downtime, to get the full story. Different reports answer different questions. A 10K gives you the big strategic picture, while a 10Q or an earnings release tells you what changed this quarter. As a GM, you use these to bridge the gap between management's claims and the facts on the ground. For U.S. public companies, the architecture is rigid. It includes audited annuals and a section called MD&A, Management's Discussion and Analysis. This is where trends and risks are disclosed. But remember, the SEC requires disclosure. It doesn't guarantee profit. Don't assume private companies have no reporting requirements. While they might not file with the SEC, they're often beholden to banks, owners, and local laws. Always check the debt agreements before assuming a private entity is invisible. Not all financial reports are created equal. There's a big difference between a management-prepared document and a full audit. An audit provides the highest level of assurance through risk-based testing, but it still doesn't certify that the company's future is bulletproof. This matrix helps you screen requirements. For a GM, the key is data precision. Publicly listed companies have higher external visibility, while private reporting frequency is often driven by the cadence of the lender or the owner. Reporting deadlines create the management heartbeat. For large companies, you have 60 days for an annual report and 40 for a quarterly. This means production and inventory data must reach finance accurately before the close, not after the earnings call. To avoid bias, I recommend a specific reading sequence. Start with the business risks and the footnotes. If you skip the notes, you might miss the very thing that explains why the headline number looks the way it does. Here is my 20-minute executive reading sequence. Check the auditor's opinion first, then look at cash flow, the price-volume bridge, asset health, and finally segment returns. Always ask, what physical mill measures would have to change for this story to be true? Looking ahead, IFRS 18 is coming in 2027. It will standardize how operating profit is shown and make it harder for management to use private language in their reports. Readiness starts now by ensuring operations owns its source data quality. The takeaway for Chapter 1 is simple. Compliance tells the market what happened, but management control changes what happens next. A future GM should lead to a standard higher than the minimum disclosure requirement. In Chapter 2, we tackle the language of results. We will look at the 3 main financial statements and the rule that every metric needs a clear boundary. The income statement, balance sheet, and cash flow statement must be read as a trio. Profit without cash is just a timing issue, and cash without reinvestment usually means you are consuming your assets. The income statement is an economic ladder. It starts with revenue and steps down through costs to reach net income. As a GM, you influence almost every step, from volume and mix to chemical costs and freight. The balance sheet is a snapshot in time. It shows what you own and what you owe. Keep in mind that a fully depreciated machine might still be your best performer, while a high book value doesn't guarantee economic viability. The cash flow statement is the truth serum. It tells you if cash was created by better operations or if it was simply borrowed by running down inventory or deferring critical maintenance. These statements are connected. Production becomes inventory, shipping triggers revenue, and collection eventually turns a receivable into cash. If these four things don't reconcile, the story you're being told is incomplete. Total revenue is more than just volume times list price. It's affected by discounts, rebates, product mix, and currency fluctuations. An increase in revenue doesn't automatically mean demand is stronger. How you calculate unit price matters. A weak calculation mixes different types of tons and ignores freight boundaries. A controlled calculation ensures you are comparing apples to apples across periods. We use a price-volume mix bridge to tell the causal story. In this example, a win in price can sometimes mask a loss in reliability. The bridge forces both of these truths to be seen on the same page. Understanding cost behavior is vital. Variable costs move with output, while fixed costs stay steady in the short term. As a GM, don't just demand fixed costs fall with volume. You have to deliberately redesign the cost structure. Each profit subtotal, gross profit, EBIT, net income, strips away a different layer. A common mistake is calling EBITDA profit without acknowledging the interest, taxes, and capital consumption that still need to be paid. EBITDA is a useful lens for comparing earning capacity, but it hides the capital required to sustain your assets. It's a proxy for cash, but it's not cash itself. When you see adjusted EBITDA, investigate every adjustment. If a one-time restructuring charge appears every single year, it's not an adjustment, it's part of the business model. Depreciation and amortization represent the cost of consuming long-lived assets. They're non-cash today, but they aren't free. If your capital spend is consistently lower than depreciation, you may be harvesting the asset. Debt and leverage are where financing meets strategy. A stable leverage ratio can be misleading if the company is growing debt and EBITDA simultaneously through acquisitions. High debt can turn an operating hiccup into a crisis. The bottom line has many layers, including taxes and earnings per share. While a GM manages the operating drivers, the final EPS also reflects corporate decisions like capital structure and portfolio changes. Working capital is essentially operations waiting to become cash. If inventory is rising, is it because of a demand miss or an outage hedge? Releasing working capital isn't always good. It can sometimes reduce your operational resilience. Free cash flow is a simple concept, but defined differently by every company. Be wary of false comfort, where FCF looks good only because maintenance was deferred or suppliers were paid late. Ratios like EBITDA margin and ROIC compress information into a single number. Never benchmark these without understanding the underlying business model, asset age, and accounting policies. Benchmarking requires normalization. Factors like forest ownership, currency, and whether a mill is integrated or not will change your margins. Benchmark the cost tree first, then the ratio. Every metric on an executive dashboard should have a clear definition sheet. If it doesn't have a defined formula, owner, and source, it's just an opinion wearing a decimal point. In Chapter 3, we look at the mill economics that drive those financial statements. This is where physical things like yield and downtime translate into profit and loss. The mill value tree shows how market demand becomes cash. A GM's job is to manage the interfaces between selling, making, and converting. Market EBITDA only turns into cash if the physical execution is disciplined. Cost behavior changes based on your time horizon. While fiber and chemicals are variable, site overhead is fixed in the short term. However, almost any cost can be redesigned over a 2-year period. Cash cost per ton is a powerful measure, but it's not a universal standard. If you hear a cost excludes downtime, that's not just a footnote. It fundamentally changes the management question you're asking. Cash fixed costs include things like labor and insurance. It's important to track both the total dollars spent and the dollars per ton. One measures spending, while the other exposes how well you are absorbing those costs. Utilities and energy, or U&E, is often the invisible department. You should track this as total cash, cost per ton, and physical intensity, making sure to normalize for both production levels and weather. Utilization is the denominator behind fixed cost pain. You must use practical, sustainable capacity as your baseline, not a historical fantasy. This helps you separate demand curtailment from actual equipment loss. This loss spiral shows why utilization is so critical. As volume falls, the cost per ton rises, which often leads to maintenance cuts, causing reliability to fall, which leads to even less volume. It's a difficult cycle to break. The cost of downtime is much more than just a repair bill. It includes loss contribution, restart losses, and even impacts on working capital and customer service. You must agree on the value of an hour before the outage happens. An idle asset isn't financially silent. Whether it's temporarily stopped or held for sale, there are ongoing costs for security, tax, and environmental monitoring. Any decision to idle must include a clear plan for the asset's future. Impairment happens when an asset's book value exceeds its recoverable economics. It's a non-cash charge, but it often reveals a very real strategic failure. A GM's duty is to ensure an accounting model isn't the first place this deterioration is documented. There's a big difference between a temporary suspension and a permanent closure. Every suspended asset needs a stop-loss date. Indefinite waiting is just an unpriced strategy that drains cash. When a mill closes permanently, it shows up as write-downs, severance, and contract exit costs. The accounting is not the business case. The real case is about the future cash and network risk you're managing. You might hear the term non-performing asset. In banking, this refers to bad loans. In our world, we should stick to industrial language. Is the asset idle, impaired, or simply non-productive? Comparing capex to depreciation provides a signal, not a verdict. If capex is consistently lower than depreciation, it's a warning of asset harvesting and growing maintenance debt. Reconcile this with your actual asset health risks. Is it maintenance or capital? Accounting rules say if it restores the asset, it's an expense. If it extends life or capacity, it might be capital. Aggressive capitalization might help today's EBITDA, but it weakens the quality of future earnings. Physical loss becomes financial cost. You need one coherent mass balance that ties together production, inventory, and cost. If your shipment system and your inventory counts don't match, you have a control problem. Groups report through operating segments. While these might be larger than a single mill, a GM still needs to understand how their site fits into that segment and what measures the chief decision maker is watching. Mill numbers don't always add up to group revenue because of intercompany eliminations. A fair mill scorecard should separate the conversion costs you can control from transfer prices and corporate allocations you can't. In a portfolio, different mills require different decisions. A core mill needs protection, while a harvest mill needs cash discipline. Giving every site the same EBITDA target is irrational if their strategic roles differ. The takeaway for Chapter 3: every financial variance has a physical signature. If you can't name that signature, whether it's yield, uptime, or quality, your diagnosis isn't finished. Chapter 4 focuses on diagnosis. A single quarter is just a photograph, but a 3 to 5 year trend reveals the true health of the operating system and the capital strategy. When reading a 5-year trend, look for divergence. If revenue is stable but volume and cash are falling, it might mean price is masking a serious operational decline. Direction and volatility tell the real story. Before you compare years, you have to fix the comparability. Adjust for acquisitions, currency swings, and even the number of weeks in a year. Don't just label years as comparable without doing the legwork. Quality of earnings is about repeatability. High-quality earnings are backed by cash and physical output. Low-quality earnings rely on one-time credits, deferred maintenance, or liquidating inventory. An EBITDA bridge forces you to explain the why in quantities. It should tie directly to operational owners and avoid double-counting effects. If price went up but reliability went down, the bridge should clearly show both. Here are 12 red flags. No single one is a death sentence, but clusters, like rising revenue with falling volume or constant adjustments every quarter, demand a deeper investigation. What if EBITDA is up, but cash is down? Check your working capital and capital expenditure. Never order a blanket inventory cut just to fix a quarterly cash metric. That often creates more problems later. When volume is up but revenue is flat, you might be destroying value. It could be an adverse product mix or heavy discounting. More tons are only valuable if they create actual contribution in cash. Rising inventory is a symptom. You need to diagnose it by reason code. Is it a planned outage build or a demand miss? A universal days on hand target can be dangerous if it ignores the reason for the stock. Financial results are lagging indicators. To see a crisis coming, you must watch operational signals. Force loss hours, maintenance backlog, quality holds, and safety excursions. These are your leading indicators. An executive dashboard should cover four truths: market, operations, economics, and assets. Each section needs an owner and a trigger for action. Change your forecast when the facts change, not just at the end of the month. Sensitivity analysis helps you quantify what could break your plan. Knowing how a $10 drop in price affects EBITDA allows you to prepare a management response, like adjusting your product mix before the hit happens. Use a scientific diagnostic sequence. Define what changed, reconcile the data, decompose the causes, test your theories, and then control the outcome. Only close in action when the physical response is sustained. The takeaway for Chapter 4. If your explanation for a result can't be tested or used to predict what happens next, it's just commentary. True control requires trends, bridges, and verified responses. In Chapter 5, we will look at real-world evidence from public companies. These examples show how to read the underlying cause behind the headlines. Take Suzano's 2025 results. They reported record revenue and low cash costs. But remember, that cost metric excludes downtime. As a GM, you want to know the total realized economics, including that downtime. Stora Enso shows how statutory and adjusted results can differ. Their IFRS result rose due to biological asset valuations, but their adjusted EBIT actually fell. For operations, the adjusted number is often the more repeatable truth. In the case of Smurfit Westrock, scale is massive, but scope and adjustment definitions are key. After a major merger, you must look closely at how EBITDA and cash conversion are defined to understand the true performance. Silvamo provides a good look at capital allocation. You have to judge their performance by the balance between reinvesting in assets and returning cash to shareholders, all while maintaining a healthy ROIC. Weyerhaeuser operates distinct engines: timberlands versus wood products. Because the economics of these segments are so different, a group-wide margin is useless for diagnosing a specific sawmill operation. Closure announcements from IP and UPM show strategic capacity removal. While closures create near-term costs, they're often designed to improve the overall network's utilization and profitability. The lesson from these cases: there is no single good or bad metric. Every headline has a hidden boundary. A disciplined reader looks for a causal, cash-backed operating thesis. Finally, Chapter 6 is about leadership response. When results are bad, you need fast containment and a scientific recovery plan, not panic-driven cuts. In the first 24 hours of a miss, freeze your facts and contain your exposures. Most importantly, don't punish the person who makes the bad news visible. Punish the person who tries to conceal it. If you miss on revenue or volume, use this playbook. Is the constraint the market, the plant's ability to make good tons, or a network shift? Don't just make more tons if you don't have the demand or the quality. When margins deteriorate, separate purchase price from consumption rates and fixed absorption. Never try to fix your cost per ton by producing inventory that no one wants to buy. If there's a cash shortfall, look for fast and safe actions like resolving billing errors. Avoid dangerous shortcuts like stretching critical suppliers or canceling safety-critical maintenance. To recover fixed cost absorption, you must either restore profitable output by fixing bottlenecks or redesign the footprint. If the market can't support the mill, stop funding a recovery story that has no evidence. This decision tree for suspended assets requires you to be honest. Is there a funded path to value? If not, you must choose to sell or close. Don't let temporary become a permanent drain on cash. Culture is the foundation of recovery. A culture that loses control fears bad news and treats forecasts as rigid commitments. A culture that recovers rewards early escalation and insists on one physical financial bridge. The GM's cadence moves from daily physics. Are we making good tons today? To quarterly strategy. Quarterly results should be the natural consequence of daily control, not a surprise you have to manage every 3 months. For a new GM, the first 90 days are about learning the economics. By day 90, you should have a mill value tree that shows your 5 largest cash losses and exactly how you plan to fix them. Next generation mill managers must be able to answer these 6 questions. If your answer is finance owns that, then you aren't yet fully governing your mill's performance. Capital governance means funding the constraint, not the loudest request. Every project, from safety to growth, must have a clear success measure and a kill trigger if the hypothesis fails. Financial literacy transforms our industry from tons at any cost to resilient value creation. A digital mill model is only useful if the underlying accounting and decision rights are disciplined. The executive promise is this: make the numbers tell the physical truth. If you can trend, bridge, and test your data, you can act before a recoverable loss becomes a strategic disaster. We've compiled a library of resources from investor.gov, the IFRS Foundation, and others. Use these to deepen your understanding of filings and the upcoming IFRS 18 changes. Here are the core reporting and accounting sources we've referenced. Always check the current laws and framework versions before applying these lessons to a real-world decision. Finally, a note on our sources and a professional disclaimer. This training is for educational purposes. Real decisions regarding impairment or closure require professional advice and current, site-specific facts. Thank you for your time today.